Okay. All right. So I have an extremely special guest with us today. And Richard Nelson, you don't really need much of an introduction because this is your second appearance on the show. So I really appreciate you coming on, specifically sharing us with us today your recent Reddit post, as well as Seeking Alpha going back a little while ago, about silver, about your prediction, your call in the surge in SLV, the silver ETF. And man, was the timing just on point. It was incredible. So props to you. And I'd love for you to just start with that kind of background, your call and the background in that, and your thinking behind it as well.
Well, first off, may I say it is truly a pleasure to be on your show again, Max. Really enjoyed speaking with you last time and getting to share my Seeking Alpha article. It's kind of funny that you talk about it as a Wall Street Bets post now because you're kind of right. I posted this on Seeking Alpha, wanting to talk about I believe it was 7 ETFs that I believe will beat the market over the next decade. And silver was one of them because I see a lot of potential in silver. I still do. Um, and didn't get a lot of traction on Seeking Alpha. They really try to promote their own pieces that are written by their writers that they pay. Totally understand that they don't want to promote a blog post by some kid who they don't know yet, but they will know, or I believe that they will know.
Right.
But talking about silver particularly, um, if you're looking back on it, the historic probability of silver's rise, um, there are three particular months that are really good. So January is a 65% chance that the price of silver rises. That correlates with the fact that in January, most people like to reorganize their portfolios, take a step back, be like, it's a new year, the whole new year, new me type philosophy where they're like, I'm going to buy some precious metals to hedge against the economy. Along with that, February is a 63% chance of rise in silver. Um, which by today, that 63% chance definitely is already hitting. Um, so you see those two stats, and then August is the other one. In August, we saw an all-time high in silver at about 27.48, 27.50. Don't know the exact number off the top of my head, but I looked at that all-time high, and I looked at how it kind of went back and took steps back in November and December towards the 23 range. I think it even might have touched the 22 range, the ETF at that time. And I said, this is the time to buy silver because 22% of US dollars were recently printed out in 2020. Uh, and silver and gold and precious metals had not corrected with that 22% because if 22% of US dollars are now printed and we have 22% more in the economy, silver and gold need to go up 22% because
Right.
otherwise their value is not correlating with the US dollar the way it should be, or the way that I personally believe it should be. Um, Another factor that I really like within silver is its value in electric vehicles. It is the best conductor of metals. It's the best metal that's an electric conductor, I should say, out of all the precious metals that we've found so far in the earth. So those two parts were two big pieces within the thesis. I really personally am someone who likes numbers and likes odds. Um, if you're into stocks, you're a betting man to some degree, and 65 plus 63% odds of them going up were odds that I felt were very in my favor when I made the original purchase in December. I did not think that February 1st would be the day where I'd be like, get to kind of put my laurels on my head and have this talk with you where I'm like, it hit, but here we are. Um, and I think that we're going to continue to see. So, like, only today did it reach the 2750 mark and surpass it, hitting at least 28. I think in the future, if one point futures had it at $29 and even 30, but it didn't really hit that mark throughout the day. It took a dip. But I do think that we re-see that $30 mark, maybe even $32 mark, based off the 22% upside from 2750, sometime within the next month, maybe even in March. Although March only has a 45% chance of the price of silver increasing, which It's not close, not as good as the 63 or 65 you see in January or February. Um, Along with that, SLV was one that I picked. If you look at the AG Majestic Silver Corp, it's a Canadian company. It got short squeezed today, and Wall Street Bets had been talking about it a bit. And the short squeeze on that was phenomenal. If anyone got in on that, props to you, because you had like a 40% gain at one point today. I did not check what it ended at market close, but that's a and either way, you're doing great. I mean, it went up it's gone up like 60% since Thursday, Friday, Monday. It's up like 60 or 80%. I don't know the exact, but clearly there is a trend where precious metals are gaining value. Um, I don't know if this is going to apply to gold quite as much. Um, I personally prefer silver over gold because of the electric conductor factor and the fact that you can use silver within different, not only just to make coins, but EVs and other technologies will have to use silver in them because of the electric conductor factor. Gold is just gold. It's shiny. It looks great. It looks great in jewelry, especially. I wish I had more gold jewelry, but it's
And
not.
it's and especially it would help a lot, especially I feel as though with the Biden administration, settling in here in the US with the new Green Deal, with industrial production, EVs in particular, he's very focused on all these new innovative areas of the economy. And we've talked about this before, the fact that speculators are focused on future innovation, well, current innovation for the future. And stocks like IBM, they recently reported earnings. They're the grandpa's old stereo kind of stock, and it dipped 10% because of their adjusted tax write-offs that they've always been sketchy, IBM, with that. That's why Jim Chanos is short, funnily enough. And you get these stocks that used to be mega caps, modern day Apples, modern day Microsofts, that are just slowly deteriorating, all because of the at least recent shift, or rather progressive shift, sector rotational shift from these grandpa old stereo kind of stocks into the current fangs, into the current EVs, ESGs, crypto, just all different areas, very rapidly changing. So my question follows: what will silver do from here on out? Will we see the continuation of this current momentum? Are we going to see a real gamma squeeze in the ETF like we've partially seen right now, but not relative to GME, to NICOA, to AMC, not so much like those? But does SLV have the potential to perform like they did or are?
So I personally believe that SLV will hit a correction relative to what inflation has gone on within our economy and correct in that manner. These last week you saw a lot. You saw especially there's one post on Wall Street Bets, got a lot of coverage because it talked about silver going from $25 to $1,000, which is an eye popper. It's one of those things where you read that and you open it because you're like, how the hell is that going to happen? And
Right.
the answer is it's not, silver's not going to $1,000. It's not. You know,
Yeah.
the price of silver might exponentially increase over the next few months. I think that at most you see kind of that 0809 recession high of, I believe silver was hovering around 50%, 50, not 50%, $50. That would give it 100% upside
Right.
from last Friday where it was at 24.99 SLV. But I really don't think that you see this crazy gamma squeeze that people are talking about where silver goes to like $100 or $1,000. I see probably about a 25% upside in silver right now. I don't see anything more. I don't see somewhere like if they knock it out of the ballpark, if a squeeze does happen, it does see that $50 0809 pre Great Recession high. But I really don't see it that getting any crazier than that due to just
Right.
historically people couldn't buy silver over the years, and then banks hold a lot of silver. And the amount of silver that people would have to buy, let's say everyone that's in Wall Street Bets, so the 7.9 million people today took their whole portfolios and made it all silver. And I'm not even talking about SLV. I'm talking about liquidate your portfolio, call someone, and just buy up silver as a like the precious metal directly. That still would not be enough silver, I don't think, to really create that gamma squeeze in the market on either the ETF or just the precious metal in general. It doesn't necessarily have to be within the ETF. It can just be silver itself's value increasing. So I don't think that we see some crazy gamma squeeze like you did with GameStop, AMC, Nokia, not no, well, Nokia is the ticker, but it seems impossible. That does not mean that it's not a great time to buy silver, even at its all-time high. There's still upside here due to the correction that needs to take place.
Yeah, it's very interesting. In environments of financial repression where you get these commodity boom and busts. But what's even more so interesting, I don't know if you've taken a look recently at the what's it called, like the Bloomberg Commodities Index, and price in equity terms, it's the cheapest it's ever been, and it has been for quite some time, for really since 2020. And even before then, it's just been a decelerating slope to the downside. So, commodities as a basket in aggregate terms is extremely cheap, even though we're seeing parabolic rises in corn, relatively speaking, in lumber, in iron ore, relatively speaking, gold and silver. I mean, they're still up. I mean, gold's up from, if you really want to be specific here, from like $35 or so from inception, at least when the Fed had it legal tender, until recently, we're at 1850 or so an ounce. Silver, I mean, silver's been quite a roller coaster ride of a cycle, but we're still trading at multi-year highs.
Yeah.
Of course, you just noted that silver, at least silver futures, were trading over 50 during 08, 09. And I mean, that just proves my point that in periods of financial repression, we see these boom and bust. But the only difference now is we're seeing it in all areas of the global economy, in all areas of financial markets. So it's really, really fascinating to pick and choose just one group of people that are all cornered into one asset, and then they dump it all and just transition to another asset, like it's a game of sticks. So it's really crazy.
So they're chasing. Um, but I think that another important factor in my silver investment, and this is kind of something I probably should have highlighted, the Buffett indicator, the Buffett Global GDP indicator, it's at 120%. So conceptually what that means is that the stock market is at 120% of the value of the current global GDP. Which, yeah, you need to factor. If it was at 5 or 10%, that would be fantastic, because that's factoring in the fact that new technologies, new innovations are going to come into the world, and they will change the game to a certain degree. But 20% is a scary mark, and it's not a scary mark because I'm saying it's a scary mark. I'm saying it's a scary mark because tech bubble, or the internet bubble of 2000/2001/1999, that 3-year period, it was there right before the market crashed. It was there in 08, 09, right before the market crashed, or 2007, I should say, before the 08 crash. And it's there again right after we had a major crash that also resulted, like, I have friends who have told me that they're up, and portfolios were up 120% this year. That's incredible, and I'm so happy for them. They also told me they started investing in March. And if you start investing in March of one of the biggest crashes ever, if not the biggest crash ever, bigger than the 1920s crash, you're probably going to be up 100% because everything corrected back to where it was at.
Yeah.
And that's not necessarily, I mean, congrats, kudos to you. But B, it's not necessarily going to stay that way because the market's so overvalued right now. So I think in that sense, I'm looking for, and people have said, like big analysts have said that the W is not happening. I think it is. I really think it is because I think that it might be not a complete W. It might be like the Dow reverts to like 27 or 28K rather than going all the way back down to its March lows, which makes total sense. I mean, I don't picture the market crashing like 10,000 points or whatever. Or I think at the lowest was at like 21. I don't picture it going down another 9,000 points. Um,
Yeah.
but I could definitely see it dropping another 1 to 2K. It's at 30 right now. 28 seems like a perfectly reasonable number for it to be at. And I think that when you look at where we're at from a recovery, we're not recovered yet. We're still in a Keynesian economic depression. I believe it's a Keynesian economic depression because there's a lot of jobs that are not held up yet. And by that definition, it is a Keynesian economic depression. And the argument against that would be that the only way to solve a Keynesian economic depression would be war. And I don't think that that's necessarily true in that sense. I don't think that we're going to have a war. So I don't think that there's anything to be solved in that sense. But I think that they're certainly looking at the job standpoint, an economic depression, which will boost the value of silver and gold, and why we had so many stimulus checks out in the past year.
Yeah, absolutely. And the Fed has a dual mandate, which is very simple. It's price stability and maximizing employment. But what are they doing to maximize those frontiers, that dual mandate? Is they're funding debt with more debt. They're giving free money away to people instead of to productive work, such as infrastructure spending. I mean, if you take a look at some of the United States' roads, in fact, maybe all of them, it needs a lot of work. And that is infrastructure is the one thing that provides many, many jobs, frankly, at very little cost. And yeah, I mean, if the municipalities want to lock down their states or counties or whatever, by all means they can. But to have the federal government lock down an entire country, it's obviously not a productive answer. It's not productive at all if you're stopping an economy. Our debt-based economy is not wired for that, and therefore the global trade economy isn't either. So what is to be done with, so, let's talk a little bit about portfolio allocation. And, let's say in a case scenario that you have a split, uh, you know, 25% kind of quarterly allocated portfolio between, cash, commodities, or any real assets, bonds, and stocks. Very simplistic kind of portfolio construction. So what is, and obviously pre-corona, the most popular kind of portfolio structure was the 60-40, and now it's considered ultimately dead. But and of course pensioners and financial advisors and fund managers, they're all telling their clients to keep long the stock market, but at the same time they've noted that there's a huge bubble. Everyone knows there's a bubble here, but they don't want to face that because nothing in their eyes is really going wrong. However, there's still millions of people on unemployment, filing for claims, millions of people out of jobs, millions of people starving. And, I don't know if you've checked out an economics textbook lately. I sure have not. But I know for a fact in these textbooks, and these Keynesian oriented textbooks, might I add, it states something like 4 quarters or 6 quarters consecutively of negative GDP growth considers a deflation. I mean, not deflation, a depression. And maybe 4 quarters of negative GDP is a recession. Now, that's highly statistical. There's no narrative behind that. I mean, people are saying we're out of recession right now, because of this huge whiplash back from negative to positive GDP. And I'm just thinking, I mean, obviously we saw a huge swing to the upside in GDP because we saw a record downside in GDP prior to it. So it shouldn't be surprising. And and yet millions of people are still filing for claims. So it's unfortunately, well, not unfortunately, recently we saw, at least 1.5 million people actually getting out of emergency pandemic, benefits. So that's a story I want to kind of grasp on at another time because I'm not too sure the specifics on that, but it's pretty significant trend starting. But anyways, so if we had this portfolio construction, how can we maybe prepare for this squeeze in commodities and thus have the narrative of inflation coming into play? We have inflation expectations skyrocketing to 3+%. So there's a lot of inflationary hype, reflationary hype really surrounding the economic narrative in this world. And if this really truly comes into fruition in headline CPI, which is frankly at one of its lowest levels in multi years, so the divergence there is quite high. What do you think about this structured portfolio?
So
environment.
In this type of environment, I specifically would be targeting a few different types of different types of commodities. I would definitely be targeting silver, obviously, as stated by my article, and just what I've been saying. I may not go. I was originally when kind of thought about this question, I was thinking gold, but the more I've thought about it, I remember you and I had a conversation a little while back, and you'd mentioned lumber, and the fact that lumber prices have been going up a lot recently, and people are building a lot of real estate. And when the economy gets back to normal, and real estate hasn't corrected yet because of coronavirus. I mean, you see people moving out of cities and moving into the suburbs, and prices of real estate are going down because of that, especially in cities. Lumber might be an investment right now. Looking into like just the whole fact that people are going to be doing a lot of construction once they're going to be building, people are going to be back to building houses and stuff like that. And that might be an asset that I actually look at. I'm actually planning to look into as I've done a little more research. Ethereum is definitely one that I would look into, especially with Ethereum 2.0 coming out. It's been on a major bull run since the fall. And I think that trend continues even more so than Bitcoin. And my main reason behind that is because Bitcoin is it's been a fantastic asset class if you owned it. I bought Bitcoin last March and I sold around 25K. Maybe should have held a little bit longer, but I bought it like 8K, so I cannot be one to complain. But basically, when looking at Ethereum, it's going to be, if there's a cryptocurrency that's going to be used in day-to-day activities, it's going to be Ethereum. My one hesitancy with Bitcoin is that, I don't know about you, but the way that I learned about Bitcoin was the way that I was first introduced to Bitcoin was when I was like 18, 17, 19, whatever age it was that I was buying my first like fake ID to go to like a bar. It was Bitcoin. And like when you think about that, like I know that, and you think about the Silk Road and the history of Bitcoin with the Silk Road, Bitcoin's been used a lot to fund illegal activities. And this is kind of going back on what Janet Yellen said, being like that she said that Bitcoin was used to fund terrorism. It probably is to a certain degree. It probably is. And I really love cryptocurrency, and I really think it's a great asset class to invest in. But I don't know if Bitcoin is related to that type of stuff. I don't know how great it's going to be. But Ethereum, especially when Ethereum 2.0 comes out and it's more secure, I see it becoming something that people use in their daily lives. So I would definitely go with that over Bitcoin if you're into cryptocurrency. Real estate, kind of jumping on the lumber fact definitely has to correct itself at some point due to all the inflation, but that's going to be more of a post-pandemic world type thing that we see. So buying real estate right now, I think, has high upside on looking at like a 5 to 10 year basis. Um, I think you'd see easily 30, like, I mean, so basically on any commodity asset class, I'm going to add the 22% market inflation from all the US dollars that were printed in 2020 because all of our assets have to correct to that eventually.
Right.
But especially with real estate, I see another 10 to 20% upside with that, especially with city real estate. That's kind of getting hurt right now. Like if you started buying up apartments in New York City 15 years from now, and I think back to my parents, they were debating moving into a suburb in New Jersey, or they were debating moving into a brownstone in New York City. Um, and they decided to move out to New Jersey, which I'm very thankful for because I made a lot of great friends and people that I keep in touch with, even throughout from the time when I was 5 years old until this very day. I still texting with them, telling them that I was doing this interview before. They're all excited for me. And like I think about that, but then I think about my parents almost bought this brownstone that tripled in value over the time from when I was 5 years old to the time when I was 18. And they always were like, oh, maybe we should have bought the brownstone because of the increase in value. It's like originally like a $500,000 brownstone that is now worth like I think 2 million now or something like that. So I think that we see something like that happen with New York City and all these big cities again after post pandemic 15, 20 years later. It's not going to be something that happens right away. It can't be because real estate takes a long time to increase in value, but that I see that theme happening again. And my parents also purchased this property right after the internet bubble. So reflecting on that, maybe similar trend,
Right.
Um,
Yeah, absolutely. And taking into note commercial real estate in itself, it's just a 45-degree angle down.
and
Um,
may I say,
it might,
don't buy malls. Malls are dead. E-commerce is going to run over malls, and that's going
yeah.
that I can get into in a second. What were you saying? Sorry.
I agree with that absolutely. Yeah, no, I was just saying that it's more that when taking into account commercial real estate against residential real estate, I mean, the rate of growth that commercial real estate has seen since, of course, the ignition of the pandemic, it's just been a 45-degree angle to the downside. And I mean, it's simple because people and businesses are realizing that they don't need to waste monthly rent, monthly utility bills, monthly electricity on things that could be operated right here at home on their desk. So
There's my two laptops for work. One, two.
there we go. Anything that's required, I mean, a desk job could be so easily done at home. Any job pertaining to that could be so easily done at home. You just hook up to Zoom and then you talk to your peers. It's that simple instead of having to pay for it very expensively. So you've seen all this commercial real estate getting liquidated, just absolutely vacant. Um, and of course, on the flip side, in residential, we're seeing people kind of rushing in. I mean, the last I checked on mortgage applications, people were piling in all because they saw the short end of the curve, the 10-year, just going up like 25, 50 basis points. People were just cramming in before it potentially spiked 2% plus. But of course, we retraced a little back down. So it's just interesting. I mean, all these people that are refinancing on record low interest rates. I mean, you've heard the commercials. Every single home mortgage commercial is about historically low interest rates, and it's being promoted like crazy.
Yep. And that kind of goes back into what you're talking about remodeling a portfolio. So I know people do 60-40 a lot with bonds. I'm anti-bond. And I'm not just anti-bond because you're not going to get good rates these days. You won't. Their interest rates are terrible on bonds these days. But what I see is that you could do real estate investment trusts, a combination of real estate investment trusts and telecom companies. And I'll give you three um, not just telecom companies, but also some other dividend plays. You mentioned IBM earlier. IBM, yes, it has lacked in the tech sector, but if you look at their consulting sector, they've been destroying in consulting for years. I mean, you look up one of their senior vice presidents, Bridget Van Kralingen, and she's one of the best consultants of all time, honestly. I've studied her immensely and the types of deals she's done, and she's killed it in the consulting industry for IBM for over a decade. Definitely one of my favorite consultants, and as someone who's working in the consulting industry, someone I look up to. Um, and then, but kind of going back into these other stocks that you could potentially do, or REITs or REITs, not REITs. I gotta stop saying that. But ABBV, that's a 5% annual dividend yield. With right now, it's sitting at $102. The price target's 147. So you're talking about a 5% dividend yield with a 31% upside. Another one, AT&T. AT&T should be sitting, you normally sits around $40. It's at 29.30 right now. Again, 25% upside, 7.3% annual yield. And then one last one, CenturyLink. CenturyLink normally sits at around $16. It has an 8.4% yield, and it's sitting at 11.90 now. So again, 25% upside with a nice yield, and all those would net you altogether. That, let's say they all hit that 31 to 30, like 25 to 33% upside, plus like 8% to 10%, 7% to 10% yield. You're talking about 50% unrealized gains before you have taxes.
Yeah.
Obviously, after taxes, it depends on your bracket and stuff like that, and when you sell. But all of those would be good ways if you were not looking to get into bonds due to the rates right now, to counter and have a dividend aspect of your portfolio. Another part of it, I would do 25% emerging markets, or maybe 20%. I would be looking into India, which is India. I in my article about ETFs, I wrote about India because I was very, very high on it. One population 1.3 billion, 1.2 to 1.3 billion, with only 500 million people using phones right now and technology, specifically IT technology. There are 800,000 people. But recently, India also is trying to ban cryptocurrency and install their own, which, in my opinion, seems like a little bit of a market manipulation scheme, especially consider like I think about the fact that trying to do a cryptocurrency when less than half their population has cell phones, and I'm like kind of scratching my head about that. That just seems like a way for the rich to get richer, you know. But looking into South America and Africa, especially, I mean, South America, somewhat, Meli is the South America. That could be a very good emerging market, but more so Jumia. And that's been a stock that people have been talking about for a little while. It's the Amazon of Africa. I look at both those stocks and I see a lot more potential in them than I do in just buying just a basic kind of like tech stock or something like that. I see an emerging market that has maybe not capitalized on technology quite as much as other countries, and could certainly really take off once these countries get to this level of technology. And when you look at India and Africa and these countries in South America, you got to remember Raj India rule. England totally, or Great Britain, the British Empire, not Great Britain or England, the British Empire totally messed up India and sent them back technologically like 100. They should be competing with China, and they are competing with China now. But they should not only be competing with China, they should be beating China. And if that type of rule did not happen, they would be. Um, and then Africa, similar concept, it was all colonized by European countries. And so they did not have the chance to advance and accelerate as a society the way that America, who was able to gain independence, or these other countries did, per se. So these are emerging markets that I believe have high potential. India is especially one that I really like. And then PIN for the Invesco India Trust is one I like because of its IT focus. And then the last part of this portfolio would be all kind of like a tech focused side of it, where one fintech stock that I wish that I'd really gotten into like 2 weeks ago, and I'd been looking at it, IPOE by Chamath. It's SoFi, so social finance. It's one of my favorite fintech stocks. I believe that financial technology over the course of time will start to beat these honestly these banks, because a lot of these banks don't have their own fintech labs. They're just buying other companies. And I think
Right.
that these fintech companies, I mean, look at Lending Club. Lending Club just bought a bank. That's a sick that like you're talking about a financial technology company that just bought a bank. They just own a bank now, and they can give out all their loans and stuff like that using that bank. And now they have a bank backing them, which is huge for them. But then I'd also definitely put in like your Apple, your Microsoft. Salesforce is probably one of my favorite stocks right now. I actually have a giant sheet of facts about it. And I love it because it's recession proof. When you look at all like Salesforce, when the market crashed in March, Salesforce crashed with it. Salesforce also rallied faster than almost any other stock because businesses still need to use Salesforce, and Salesforce is accessible from your computer, from any computer actually. You just have to log in, and then you have access to all your company's data and all your needs, and can organize and send stuff out, and just keep track of everything. So it's recession resistant, which is fantastic. Its revenue grew 44%. No, 40. I can't even read my own handwriting. Um, so in 2009, revenue grew 44%, 21% in 2010, 21% in 2011, and it's still growing. It grew 26% year over year in 2021. It's continued to grow throughout the decade, and it's shown great growth. It has $200 billion market cap, and it's trading 8 times less than next year's sales. Other types of stocks like this usually trade way more. Like Viva Systems trades at 90 times earnings. So if Salesforce is trading at 8 times less than next year's sales and Viva is trading at 90 times earnings, and they're their competitors, they should be trading much, much higher, you know?
Right.
Because if they were trading at 90 times earnings, they'd probably be the most valued stock on the market right now. But no controversy also. There's no like tech controversy that's going on. Like, I mean, Robinhood, nobody's going to buy Robinhood's IPO anymore. That's for sure. That's just going to flop. And then also the acquisition of Slack. I'm someone who uses Salesforce on a daily basis. And it was kind of funny because, at work, I'd always be messaging people on Slack anyways. So now they just own each other, and Salesforce's weakest feature was its chatter, which was not, the chatter feature was not very good for communication with coworkers, and they've solved that issue. So they hit my one personal pain point was that I couldn't really talk to people very well in Salesforce. So once they bought Slack, I was like, oh, bet. Like,
Works perfectly.
yeah, it's just like, oh, you guys needed this and you acquired it. Like, wow, that's impressive. But yeah, I would do 25% emerging maybe not 25% emerging markets. I probably do about 20% emerging markets, 30% these Salesforce, Apple, Microsoft, just your major tech players that are going to be continuing to expand. I mean, you look at, Apple has the most popular messaging system in the world, which is absurd because you don't even realize that you're just sending your text out in blue instead of green. I would do 20% emerging markets, 30% these tech stocks, probably 20% on these different REITs and different dividend plays like IBM, ABBV, T, and then the rest would be all in Ethereum, lumber, silver, gold if that's your type, if that's your taking. If Bitcoin dropped below 25K, I'm buying the crap out of it, honestly, even though, like I said, I think it funds terrorism, but that's too sweet of a price at 25, below 25K these days. But
I mean, that sounds like a much better yield opportunity than it would be if you were invested in, HYG, high yield bonds, which
yeah.
last time I checked, it has not even a 5% dividend yield. And in real terms, you're making like what's considering like 10-year break evens, that's like a 2% gain.
Especially when you
Not
factor in
attractive.
like what if someone, and then we put out new stimulus and now the inflation's made your gains nothing.
Exactly. Yeah. Exactly. And yeah, and then that 60/40 portfolio, it's just dead. It really is just dead. And it's crazy how fast it died, the whole ideology behind it. Because, I mean, that was in pretty much every single pensioner's portfolio. That was the structure. Um, and now it's really just all in on ARK. It's all in on XLK. It's just and SPY. It's really just unbelievable.
Yeah, no, it's crazy. I mean, but part of it's this Robinhood investing theme. Like, you have all these people who didn't have access to free trades and didn't really understand the market per se prior to this, and they weren't interested in understanding the market. They were just interested in maxing out. They knew max out your 401k, have a financial advisor do his thing, and if he's good, you'll be rich, and if he's not, you still be fine as long as you keep holding your job and you max out your 401k. But now we're seeing people doing their own money management, which is awesome. In my opinion, it's awesome. I mean, I've been keeping track of Wall Street Bets, obviously. I mean, I wrote my silver post on it. I've watched it. If Wall Street Bets was a stock over the past 3 weeks, it would have gained 200%. And that's absurd. It's like, people are, it's like that meme of Leo from Django Unchained. You had my curiosity, but now you have my attention. It's
Yeah,
like
right.
it's like they got people's attention, and people are going there. And yeah, GameStop was down. GameStop was down like $100 today or whatever. But people are still like, we like the stock, we like the stock, and there's so much controversy going on within that. It's crazy. I mean, what Robinhood did, in my opinion, is unacceptable. I understand that it didn't have the funds, but you shouldn't be a brokerage if you don't have the funds to supply your whole entire market.
Yeah.
And I get they can say, "Oh, we weren't expecting this," but nobody expected anything. It's the market. No, you can't expect anything these days, and everyone has a plan until they get punched in the face. And Robinhood got punched in the face, and it was pretty clear that not only did they not have a plan, but they didn't give a crap about their clients.
Yeah.
It's
Totally
definitely
agree.
affected. And if they did give a crap about their clients, it was the hedge funds, which I don't necessarily agree with. I think, your clients are yes, the hedge funds were paying for your data, and that was what was making you your money. But if you don't have anyone trading on your platform, you're not going to have any data. They're not going to have the same data that they used to, because everyone that I know, Robinhood, is now using Webull, or I know SoFi. Like, we're going to set up a brokerage ASAP, and that sent up like it was at 20. It was trading at like $20 last week. Now it's like 26, 27 throughout today. So they're really losing their market. They were the most popular, and they're really losing a lot of market share right now. And it kind of brings me into this whole Wall Street. I definitely want to talk about Wall Street Bets right now, because what's going on there is incredible. The most as Chamath put it, the most decentralized hedge fund you will ever see. And you're right, it is the most like, as someone who wrote about silver on it, if I made my post today, I would have been called a bot. I would have been vilified to the max. Luckily, I posted it last week when people were pro silver and didn't realize that Citadel owned it. First of all, may I say that anyone who's decided not to buy silver on Friday or whatever, because they felt they were planning to buy it earlier in the week, and then they read that Citadel owned it and decided not to, they gotta check their priorities, because if you're trading in the market, your priority shouldn't be to make a point. It should be to make your dollars.
Right.
It
And allow me to remind the audience really quick, just the title of your Reddit post, and we'll have it in the description of the video, of course. It's called "Why I Think We See SLV Hit an All-Time High in February." Yeah, just wanted to list that for the viewers.
Yes, and so we saw it hit the 8-year high today, as I believe we said earlier. But just talking about kind of this Wall Street bets concept and just what they've done to the market, I mean, it's creating unprecedented volatility. Like the market's never seen this many traders before, and that's an amazing feat. And kudos to Wall Street Bets. Um, kudos to Deep Effing Value, because that guy's a beast. I love that guy. I read the article about on Wall Street Journal to him, and he's awesome. Just your average dude at Mass Mutual just that was like, I see something. And but kind of getting back onto topic, sorry, I'm sidetracking. Um, you're having now about 8 million people on a page that discuss every day, that not most of these people are checking this every day because they're looking for the next play. And it's going to create unprecedented volatility because you're going to see more GameStops than you ever did before. You're going to see people really targeting short squeezes, and it's going to affect hedge funds. And like we saw last week, where the hedge funds lost on like Wednesday or Thursday, and they definitely had to cover, or they had to pull assets out from other places because the rest of the market tanked. And it was clear that the shorts had to cover, and they were pulling from others. And it caused everything to be down except GameStop, AMC, Nokia, Naked, what else? CTRM is another one. Whatever Robinhood tried to ban basically was what was going up. And you're going to continue. We're going to continue to see that volatility throughout this month. And February tends to be a down month, historically speaking. Ironically, February 1st happens to be one of the best days of this month. It's been green 16 out of the past 19 times, including today. But looking at today, I was looking for if the market recovered 500, 600 points as it lost Friday, I would have said, okay, the market's going to start an uptrend, and I was wrong, and February might be a really good month for the market this year, and that's a rare thing. Don't think I was wrong because it didn't cover. It only, what did it go up here? I have Schwab up, I think. No, I don't. Okay. Well, I think it was, I'm going to guesstimate 250, between 250 and 300, I'll guesstimate. And that's only half of what I was looking for in order to see it gap up. So I think we see a downtrend at least the week, if not the rest of the month. But obviously there will be green in that. I don't want to be too pessimistic. I think that we see a reversion to about 28K, maybe 27 if things are going really bad. If positive job reports and stuff like that happen, maybe 29K. And this is kind of echoing one of my favorite investors, Cathie Wood, who said that she believed the markets would wobble. And that was back when it was at an all-time high. So we're starting to see that wobble take place. I think it goes through the month of February, maybe into March a little bit, and then we start to see a recovery again. But I'm personally buying up the VIX because I see this volatility that 25% of retail investors are new to investing right now. They started in 2020 or 2021. You're seeing an unprecedented amount of of new investors, just generally speaking, just normal like people like you and me that are investing now. And that's going to just lead to an increase in volatility, especially if 8 million of these people out of whatever many it is are going on this page and saying, I'm going to just buy what everyone else is buying and send it soaring, because you're going to see more and more hedge funds being like, jumping on these trains and but taking money from other plays that they had going on and putting it there. And I think BlackRock owns 13% of GameStop right now. Which I believe they bought like a 13.5% share of GameStop. I don't know when exactly they purchased it. Here, wait. I don't want to be saying false information on this. BlackRock, GameStop.
Yeah, let's find that out.
BlackRock's $3 billion gains show how GameStop could rally. Okay, wait. Here. Business Insider. BlackRock this was 5 days ago. BlackRock has likely made $1.2 billion in GameStop as day traders buy the stock to stick it to Wall Street. BlackRock
Wow.
likely scored a 700% gain on GameStop this month, thanks to day traders boosting the stock. The world's largest asset manager owned 9.2 million shares worth 174 million at the end of 2020. So
Unbelievable.
they're third, yeah. So they did own 13% of GameStop back in November. So kudos to them, Deep Effing Value and Michael Burry. You guys are all the goats for this month or last month.
It's just crazy to think of this new trade-off phenomenon that is between retailers and institutions. It's completely flipped. We've never seen anything like this before, and we haven't seen much of anything that we've seen before this past year. It's all just unprecedented things left and right are happening. But this phenomenon in particular, it's truly it's a regime change in not just the stock market but financial markets, because I mean, like we've been talking about, money flow is so easily extracted and even exacerbated from one asset to another so arbitrarily as well.
Yeah.
And so here's another question. Is this GameStop in particular, I mean, when's it going to end? You said that, Wall Street Bets in particular isn't really ending anytime soon. In fact, they're just growing at a rapid pace in terms of their saturation. So are they going to just hop in and out of different stocks, or are they going to stick to the ones they've been trying to, well, they've successfully hyped up until the inevitable
Crash.
Yeah, the inevitable crash.
I think that they try, and I think that GameStop is going to be around at least this month. But it's one of those things where how long can you keep a meme going? How long can you keep people from into this? It's like,
Right.
how long can you keep the population engaged? That's not really something I can answer, because I'm a single dude in the population who, I own 2 shares of GameStop, and I bought at a terrible price. I bought it because I just wanted the FOMO. Honestly, I was like, I just want some GameStop, man. And I'm down like $100 on it. And I'm just like, whatever, I'll make that. Like, and I day traded something today to make $100. So it's even per se in my mental mind. I'm like, oh, I made it worth it.
Yeah.
But the reality
That's
is,
ideal.
yeah, it's like, I bought it because I wanted to be part of this trend. And the question is, how many people are going to buy that because they want to be part of the trend? And I've seen people on Wall Street Bets post like, I just put $1 million into GameStop. And I'm just like, yo, like, I didn't know if I wanted to put $500 in here. Like, if you're putting $1 million, like $1 million, like, do you know what? Like, like $1 million in GameStop, man? Like, if people are doing that, like, it's bound to keep going up like crazy. But the question is,
Yeah.
how many people are actually doing that, and how many people are like, just buy, like, most people are just like the average Joe like me who bought 2 shares because they wanted to just be part of this movement, and they bought them at $300 on Friday because they were like, if I don't buy it, and then you already know that there's going to be a massive, like, let's say GameStop hits 420, specifically the number 42069, because these are high schoolers in GameStop. And because I would bet you that if you looked up if there was a way to look up the amount of limit orders on GameStop at 42069 limit sells, you'd probably see like over 1 million orders to sell at 42069, just because these want to be like,
I wouldn't doubt that.
And like, don't get me wrong, I love that. I love doing stuff like that for the meme, but I'm also someone who does not believe that you should be playing with your money like memes, which is being a hypocrite, because I totally bought GameStop for the meme. But generally speaking, I don't think that that's a good idea. But at the same time, if the shorts don't cut, if the shorts have to, if people win and the stock goes to $1,000, it'd be pretty ludicrous. And I'd love to see it happen. I just don't know if it's gonna happen. And if it doesn't happen by the end of this month, I don't see it happening. If it does happen by the end of this month, I don't think you just see GameStop go up, but like I kind of going back to where I was, the original, if GameStop goes to $1,000, the VIX is going to $100, man. Because
I could see that.
the volatility that you would see from GameStop, AMC, and all these shorts having to cover if this happened, it would just be a whole new world of volatility for our markets. I mean, we would have never seen something like that happen before.
Right. It's unbelievable how many, and you mentioned, what was the stat you gave us? It was 25% of new traders. I don't know, but the amount of new traders, the colossal amount of new
increase in retail traders since 2020.
Okay, gotcha. So those people that are just entering market, the stock market, but they're also entering the options market at unprecedented levels. I mean, call buying activity, throughout all these different stocks, it's not, it's just unbelievable. It's just nonstop. And well, in the meantime, we have the Fed owning a third of the TIPS market, a third of the MBS market, a third of the entire yield curve. So it's we really truly are in crazy times.
Yeah.
I wanted to bring up one more thing, but I'm just blanking out at the moment. Did you want to mention anything while I think of that something?
Let me think. I'll think of something to mention. Oh, here's one for the fans. Space, SPCE. There's an interesting short squeeze going on there. Definitely worth looking into. It's a little bit overpriced right now, but if it dips, it's like 71% short interest, only 7% less than AMC. Space could go to the moon, quite literally. No pun intended. But
hopefully people have the same tolerance for Richard Branson for what they do for Elon Musk. We'll see who has more spite.
I think that people will like Richard Branson as much as Elon Musk. He's just as personable. He just has to get more active on Twitter, I guess. I'm not a big, I know I need to get more onto Twitter because a lot of big investors like to tweet, but I have not been on Twitter very often. I need to get on it more.
Yeah, I'm on it quite often. I can't get enough of it, man, because truly, you get a whole lot of different perspectives on all these different kinds of strategists all over the world, and you get a lot of data from them as well. And it really is a great community. But anyways, I think we might as well just cut it off here. And like I said earlier, we'll have all your information in the description of the video for our viewers to view. And I really appreciate you coming on, Richard. This was really a fantastic conversation. Productive
Really
as always.
It's always fun being on here.
Absolutely. It's my greatest pleasure as well. And I hope you have a good one.
Sounds good. I will talk to you very soon.
All right. Stay safe.
You too.